I've owned sole proprietorships, LLCs, S Corps, and C corporations. And in today's video, I'm going to explain exactly how to pay yourself from the top types of business entities. So you're not going to want to miss this. Without further ado, let's dive in. All right, guys, let's start off with the sole proprietorship. A sole proprietorship is a type of business that is owned and operated by a single individual. In this structure, there's no legal distinction between the business and the owner, meaning the owner is personally responsible for all aspects of the business, including its debts and liabilities. You see, as the sole proprietor, the business profits are considered your personal income. The business itself doesn't pay you a salary, and instead, you withdraw money from the business whenever you need it. When you take money out of the business, it's considered an owner's draw and not a salary. It's not considered a wage. So sole proprietors are not legally required to have a separate business bank account, but it can be very helpful to do so for tax purposes. Let me explain. It can be a lot easier to track business income. It can be easier to track business expenses. If you do have a business bank account, you can make owner's draws by writing a check to yourself, making a direct transfer via online banking, or even withdrawing cash from your business account and depositing into your personal account. Since you're the owner, there's no need to set up payroll or issue yourself a paycheck like you would if you were a corporation. Your business income just simply flows into your personal finances. You don't have to withhold payroll taxes like an employer would for an employee. But keep in mind that you will owe both self-employment taxes and income taxes on the income that you generate with this type of business. When you take money from the business, it should be recorded as a withdrawal in your accounting system. Doing this is important for tracking your personal income for tax purposes. Next is a partnership. Partnership is a type of business entity where two or more individuals or entities team up to operate a business. Partnerships are extremely popular, and they're typically governed by a partnership agreement, which outlines each partner's role. It also outlines each partner's contributions, profit distributions, and how disputes will get resolved. Here are the general ways that partners can pay themselves. Number one, an owner's draw. In most partnerships, partners usually take money out of the business as owner's draws rather than salaries. With an owner's draw, partners can take out funds from the business account as needed, just like how sole proprietors can. The amount taken is not considered a salary, but rather a withdrawal of the profits that the business is generating. And these withdrawals are typically not subject to payroll taxes, but they are still subject to income taxes on the partner's individual tax returns. Number two is guaranteed payments. In limited partnerships, some business owners may agree to pay a partner a guaranteed payment. This is a fixed amount paid to a partner regardless of the partner's profit or losses. The type of payment is typically outlined in the partnership agreement. Number three is profit distributions. If the partnership is making a profit, the partners will typically share that profit according to the terms of the partnership agreement. This is usually done annually or quarterly, but the specific schedule should be agreed upon by the partners. Okay, now let's talk about a different entity type, an LLC. An LLC is an extremely popular business entity that combines the liability protection of a corporation with the flexibility and tax benefits of a partnership. With a single member LLC, profit and losses can be passed through to the member's personal tax returns without being taxed at the business level. Here's how to pay yourself from a single member LLC or a multi-member LLC. Single member LLCs, if you're the single owner of the LLC, well, the IRS treats you as what's called a disregarded entity. By default, it means that you're taxed like a sole proprietorship. You don't actually pay yourself a salary in the traditional sense. Instead, you just take draws from the business's profits. You do this by transferring money from the business account to your personal account whenever you want. Remember that you need to keep track of the draws for tax purposes, but no payroll taxes are withheld. The LLC's profits are reported on your personal income returns on a Schedule C, and you'll pay self-employment taxes just like a sole proprietor. What about multi-member LLCs? If your LLC has multiple owners, the IRS typically treats the LLC as a partnership unless you choose to be taxed as a corporation. In this case, members don't get a salary, but instead take distributions from the profits, similar to a single member LLC. With a multi-member LLC, owners take draws from the business profits that's agreed by the members. You also receive a K-1 form at the end of the year. This reports your share of the LLC's profits on your personal taxes. Each member pays self-employment taxes on their share of the LLC's profits, not on what they draw from the company. The business itself doesn't pay taxes, but it reports income on a partnership return called a 1065. When I was first getting started in business, I set up a single member LLC and I reported all of my income underneath a single member LLC. I had a bank account for the single member LLC, and anytime I needed to transfer money to myself, I would take an owner's draw. I would transfer money from the business account to my personal account. The beautiful part about this is when I did this, at the time, I was not paying taxes. Even though I still owe taxes on the money I'm transferring, because I'm a self-employed business owner, I'm not paying taxes at the time that I'm transferring the money to myself. This is the advantage of having an LLC. You could take tax-free distributions in real time. What I also did over time as I grew my company is I transitioned to an S corporation. An S corp is a type of corporation that allows for pass-through taxation. This means the business itself does not pay federal income taxes just like an LLC or a partnership. Instead, the business's income passes through to its shareholders who report income on their personal tax returns. This helps avoid double taxation that regular C corporations face, where both the corporation and its shareholders are taxed. Now, there are two main ways to pay yourself as an S corp. You can take a reasonable salary and distributions. Paying yourself a reasonable salary is super important because as a shareholder, you're an employee of the S Corp. You can pay yourself a reasonable salary for the work you perform for the business. Here at my firm, I always recommend this to be somewhere around 30% of the business net profits, but that changes relative to what we are trying to qualify for on the tax returns. Maybe we're trying to qualify to receive what's called a QBI deduction. Maybe we're trying to max out retirement contributions, or maybe we don't need to report so much income on payroll, so we might adjust that. But for a rule of thumb, we typically use around 30% of the business's net profit as a reasonable salary. Otherwise, you run the risk of IRS claiming that salary is not reasonable and coming after that. Now, this is not what I want, and nor do we get a lot of taxpayers experiencing this. But the IRS expects the salary to be in line with industry standards for your role. So before assigning yourself a salary, do some research on what others in your industry are earning for similar work. For the salary portion of your income, you need to withhold payroll taxes. This means withholding Social Security, Medicare, federal income tax, and state and local taxes if applicable from your salary. You also need to pay these amounts to the IRS through regular payroll filings. Your salary is also subject to unemployment taxes, both federal and state, if applicable. Step number 2 as an S corporation owner is taking distributions. After you have taken a reasonable salary, you can take profits out of the business as distributions. These distributions are not subject to payroll taxes, which is a major tax advantage of the S Corp. In fact, being able to take a larger portion of your income without having to pay payroll taxes is one of the main reasons why many people switch to S corporations in the first place. But keep in mind, even though distributions are not subject to payroll taxes, they're still taxed as a part of your income on your individual tax returns. For example, if your business earns $200,000 and you decide to pay yourself a salary of $60,000, you pay payroll taxes on the $60,000. You could take the remaining $160,000 as distributions, which would be subject to federal taxes, no payroll taxes. This is what makes S Corps amazing. Welcome to C Corps. A C corporation is a type of corporation that is separate from its owners from a legal perspective. This means the corporation itself can enter into contracts, sue or be sued, and importantly, it pays taxes independently of its owners. However, C Corp owners are taxed again at the individual level. This is known as double taxation. C corporation owners generally do not directly pay themselves in the same way a sole proprietorship or a partnership does when it comes to taking money out of the business. Instead, they typically receive compensation through a salary and or dividends. And if you're getting a salary, this means that you work for the C corporation as an employee. You can receive a salary just like any other employee. This salary is subject to payroll taxes, and the IRS requires that the C corporation pay owner employees a reasonable salary for the work that they do. Just like how an S corporation owner has to take a reasonable salary, same thing exists for a C Corp. This prevents owners from avoiding payroll taxes by taking only dividends. Now, the C Corp is responsible for withholding income taxes, Social Security taxes, Medicare taxes from the owner's salary and submitting them to the IRS. Dividends. If the C Corp makes a profit, it can distribute dividends to shareholders. They're typically paid out of the corporation's after-tax profits. Dividends are taxed twice. First, the corporation pays taxes on the profits at the corporate tax rate. Then, when the profits are distributed as dividends to the shareholders, those dividends are taxed again on the individual level. Unlike salary, dividends are not subject to Social Security or Medicare taxes, so you save out on 15.3% there. Okay, now that we've gone through how to pay yourself from a sole proprietorship, we talked about partnerships, we talked about LLCs, single member and multi-member LLCs, as well as S Corps and C Corps, I want to answer a question from Bob Zulez on how to turn everyday expenses into write-offs video. Make sure that you check out that video if you haven't. The question was, Karlton, what happens if you need an asset in order to do business, i.e. a phone or a laptop, but you also use it for personal use? Shouldn't that be 100% since you cannot do business without it, but could possibly personally live without it? This is where the IRS has what's called de minimis expenses. IRS will allow for you to write off your cell phone, write off your laptop. Typically, they want to know what percentage of the laptop's in business use, what percentage of your cell phone is in business use. But if you think about it, most of these expenses aren't expenses that the IRS is going to fight you over. A laptop or a cell phone that you can turn around and jump on and have a personal phone call with, or your laptop where you can research something personal for yourself, right? They understand that you need these tools in order to conduct business, but at the same time, someone might personally call you on it. To play it safe, what I'd recommend, have a business laptop and a business cell phone, have a personal laptop and a personal cell phone. These are things that I did as I started building up my business. I just started buying things that made sense for the business and kept things that were personal, solely personal. And it's a benefit to you as you grow as a business owner. Having a business phone and having a personal phone can help you segregate the personal relationships you have in your life that are important versus the business relationships you have in your life that are important. I know my family appreciates it that when I respond to their text messages and their phone calls within a 12 to 24 hour return policy. And I know my business clients appreciate when I return their phone calls and text messages in a 12 to 24 hour return policy. But sometimes when I have all those things jumbled up together, it becomes overwhelming and I don't respond to everybody. So I have separated my personal cell phone from my business cell phone, my personal laptop from my business laptop, and this can help you as it pertains to saving money on taxes. My name is Karlton Dennis. Thank you so much for watching this video. You can do something for me. Like, comment, subscribe. You know what it is. I'll see you on the next video. Cheers.